All right, welcome, folks. This is David Lincoln reporting to you from the outside of the SIBO. Actually, it's just a green screen, folks. Sorry about that. But we can imagine we're outside the front of the SIBO. And I did just notice the breaking news story that we did see the arrest of Julian Assange. Finally, the Ecuadorian embassy has retracted their diplomatic immunity for him. Now, this was kind of in the cards for a while now, as they were reporting them being increasingly unhappy with the guy. He looks like some sort of Chinese guru or something with his long beard here. You can see that picture in the thumbnail. But actually, let me just pull that picture up so we can see it right here for a second. But pretty crazy turn of events here, and we'll see. I mean, the U.S. wants to get their mitts on this guy, of course, because they're not happy with his leaking stuff. So there he is off to the right of me, being removed from the embassy. And we will see what happens from there. I guess he was indicted. Let's pull up the article really quick so we can look at it. I think he was indicted. Julian Assange has been charged by the U.S. for computer-related offenses after he was arrested by the Metropolitan Police earlier today. He has now been found guilty in a U.K. court for skipping bail. The WikiLeaks founder faces possible extradition to the U.S. after being expelled from the Ecuadorian embassy, where he was hiding as a fugitive for 7 years. So stay tuned for updates on that story. All right, so I came on today. I want to talk about a successful trade that I put on and then took off in UVXY in the last 24 hours, and sort of my thought process and how you could go about doing a similar trade to this next time UVXY pops. So let's talk about that first. My most recent guest I had on Jay from tradingvolatility.net. I asked him at one point, he has a trading system that sort of automatically trades volatility. And I mentioned to him one of the strategies that I like, which is to basically keep your money in cash until UVXY pops, and then put an options trade on that will capture the down move. So essentially, it's an opportunistic trade that you wait around and you're ready for that to happen, and you respond when we get a pop. So if we look at UVXY, the chart, and that's not UVXY chart, that's Spotify. We look at UVXY chart, we can see that 2 days ago we had a little bit of a pop. Let's see if I can do this right here. And once it popped, there became an opportunity here, and we can see it here Tuesday during the day. It's building up, and then and it got up to 38.50, just about right on the close of Tuesday. So my antennas come up, and I say, here's an opportunity. Maybe this thing is going to go higher from here, and it certainly could have. We could have come in on Wednesday morning and seen this higher, but regardless, we've gotten a pop and an opportunity to short this, because we know it's going to go lower eventually, and contango has been building currently today over 9%, but contango's been building. So I came in on Wednesday. Stock was around 37.75, and so I said I want to put on a trade that will get me short with options so that I can capture this down move. And indeed, it did follow through to the downside. You can see it going from 37.50 here, now down to 35.60. So what did I do? Which options did I pick? Well, I'll tell you right here. I picked the I went out to May, a couple weeks out, and I picked the 17 May options, and I picked a put spread. So I'm buying one put, selling another. I'm buying a higher strike and selling a lower strike. So it's a defined risk trade. So which strikes did I pick? I picked buying the 39 put, and I'm going to execute a trade here or show you how I did it. So I click on the offer of the May 39 put here on the screen, and then I hold down the control button and I click on the bid of the 37 put, and it's going to bring up this order screen, which I will attempt to enlarge a little bit here for you so you can see it even better. And what that showed at the time was me buying. Now, okay, so the 37.39 put spread, there's $2 between the strikes. So the most that this can be worth is $2. The least that this can be worth is nothing. At the time, the spread was offered at $1.30. So if on expiration UVXY is below 37, this will be worth $2. So if you're paying $1.30, what you're doing is you're coming in, you're paying $1.30 for each spread, so $130, and then you're expecting that if this goes lower and stays lower, you will be able to sell this for $2, or it will expire worth $2 on expiration. So $130, you're putting $130 in, getting $200 out. That's the expectation of the trade. So I came in, I paid $130 for this, and I ended up buying it just 3 times, just a small trade. Actually, I think I bought it 4 times. Just a small trade, so costs me $520 to put the trade on, $500. Actually, I might have done it bigger than that. But anyways, in this example, it cost $500 to put the trade on. And so I put the trade on. I bought it. Now the stock moved lower, and the spread went up in value. If we were to analyze the spread in our analysis, let's put the trade on one more time. So buying the 39 put, selling the 37 put. If we were to put this trade on 10 times and go to our analysis tab here, what I can do is right click on the trade and select analyze trade. If I pull up price slices, so if we do this trade 10 times, it's the equivalent of being short 70 shares of the stock. So similar situation to selling 70 shares of UVXY short. I know it's not a stock, it's an ETP, but it's just sort of shorthand calling it a stock. Equivalent to selling 70 shares, but the good news is that if this were to explode to 100, 200, some huge negative news came out, we're only on the hook for the $500 we put in, and not like an infinite amount. That's the beauty of putting a spread on. But equivalent at this price to short 70 shares. Now, as the stock moves around, the equivalence of the spread is going to change, and as time goes by, the equivalence of the spread is going to change. But that just gives you a rough idea that if the stock goes down $1, you'll make $70. Stock goes down $2, you'll make $140 for a $500 sort of risk. So sure enough, I put on this spread. I bought the 39.37 put spread. Stock did go down about $2, and so we could wait till expiration and collect the full $2 on the spread, or you can just collect the amount of money that it made overnight, because remember, the spread's still in play. There's still a few weeks till expiration. So it appears at this moment that UVXY will expire below 37, but you kind of really never know. So you could decide to either leave this trade on or take it off. But either way, you would have profited from putting this short trade on, because we did indeed go lower after that spike 2 days ago. All right. Now I want to show you a trade in Netflix, and this I like to think of almost as spinning the roulette wheel because there's almost a 50-50 shot on this trade. I essentially found an at-the-money spread to sell, and so let's go to Netflix for a second, take a look at it. All right, so Netflix trading around 364 right now, and I looked at the spread a week out, and I picked something almost at the money, so it's a little higher than it was when I put this trade on, but I decided I would sell the 18 April 360, 355 put vertical spread. So I sold the 360 put. So I'm clicking on the bid for that put now, and then I'm holding control and clicking on the offer for the 355 put. So it's a $5 spread. And if we were to sell this $5 spread for $2.50, which is the midpoint of the spread, then we've sold the spread for half its value. And if we're right around that price, stock could go either way. It could either be above or below this 360 level on expiration, which is in only 7 days. And essentially, there's a 50-50 chance that it will be above or below that level. So that's why I say this is kind of a spin of the roulette wheel. Now, in this particular case, I didn't end up selling the spread for $2.50. I sold it for a little bit less than that, partially due to the fact that the 360 level is a little bit below where the stock is right now. So there's a little bit better than a 50-50 chance that this will be a winner, and thus it pays a little bit less than 50% odds, which makes sense. If it was completely, if the spread was exactly at the money, if it was something that was right in the middle of being at the money, then there would have been an exact 50-50 chance, and it would have been priced accordingly for $2.50. This was slightly out of the money and thus slightly lower odds, but still, in my mind, a crapshoot. I don't know what Netflix is going to do. I know the earnings are coming out before this option expires, and if earnings are good, it might go up, down, or sideways. Who knows? But there's a 50-50 chance that this will work. Now, a lot of people go out and buy scratch tickets where there's your odds are highly against you. So this might, if you're into wagering a little bit of money, better to have sort of fair odds than to have it tipped heavily against you. The other thing about this trade is that if it goes your way, you can take it off before earnings, and thus just lock in a little money and move on with your life, which is something I might consider doing now because the trade's gone my way. The stock's up about $3 since I sold this put spread. All right, so let's move on to the really the elephant in the room for my portfolio right now, which is this trade in FGen. Now, this is a company that could quite literally cure cancer at some point, which would be great for the world, but not for my position at the moment. And this is one that I don't recommend that you follow me over the cliff on without knowing exactly what you're getting into. This is a very illiquid stock. Okay, it's traded 42,000 shares so far today, and if we were to go and look under, I like to look at the Analyze tab on my Thinkorswim to get kind of see what's going on. So if we go to the Analyze tab here, we can look at options time and sales for this one, and you can see behind me there's only been a few trades today, and this is fairly typical of this. It doesn't trade very much at all. That's those few trades that you can't see on the screen because the screen's messed up. Let me fix the screen here. It's only had a few trades today. And you can see them there behind me now. 1, 2, 3, 4, 5. So five total trades today in this particular product. And thus, if you want to put something on when there's not liquidity, A, they're going to make you pay a little bit to put it on, and B, you're not going to be able to kind of get in and out of it quick. You know, if we look at something like Apple, it's going to have like a massive amount of trades every day. And you can, if you decide, tomorrow, I don't really want to have all my money in Apple, you can very quickly get out of it. Look, these are just trades that happened behind me, are just trades that happened at 10:25 today. It's over a page of trades happening just in that minute of 10:25. But FGen, a lot less liquid. And if we were to look at the option screens here, we can see the markets are very wide here. This April, 7 days to go, April 55 calls, 255 bid, offered at 480. So dollars wide in this stuff. However, things did line up in this in a way that I thought was a really good trade, and I was willing to sacrifice a little bit of edge to put it on because I thought it was that good of a trade. And so let's talk about that now. If we look at the various months in the stock, and I went on the StockTwits page, and people are fully expecting, and I also looked into the company more, and people are fully expecting that they're going to release results of one or two different drugs that they have that they're working on right now. And those results are going to come soon according to the options, because these April options with 7 days to go are cranked up. The vol is showing 157 right now. If you look at these volatility numbers behind me, those are really crucial to the story here with this one. And I look around for stocks and try to find ones that have profiles that look like this. So let me see if I can make these bigger here. Okay, so if I pull up my little handy dandy pointer here. All right, so if we look at these numbers here, these are the numbers of the volatility levels in different months. Okay, so and to the right of them is the equivalent dollar move. So somebody's expecting this to move $10 in the next 7 days, up or down. And you can see that, like most stocks, the volatility levels go down as you go out in options. When there's an event happening, it pulls up the first months, and the other months get pulled up with it. But the longer-term average, the further out you go, the closer the options are going to stay to the longer-term average for the volatility. But you see that there is a big differential in these last 2 months, 73 versus 105. So that's like a 30-point vol differential. And we know the farther we get in time, these vol differentials mean real dollars as we get farther out in time. Now, another way to analyze a stock before you were to put on a position would be to look under the options statistics tab on your analyze in thinkorswim. So if I go down here, we can see options statistics. Okay, and it shows, of course, I'm right in the way of it. But if you look off to my left here, it's going to show 52-week implied volatility high, 125. Now, we know that's not true because we just saw implied volatility of 150 for the front month. So this needs to be updated. Low, 36. So volatility is anywhere from 36 to 125, corrected to like I know it got up to 160 like 2 days ago, so this isn't completely accurate. But current implied volatility percentile, 98. So these options are the highest price historically. They're in the 98th percentile of their price level, so very high. Then we have 52-week HV. HV is actually how much the stock is moving around. IV, implied volatility, would be what the options are pricing in stuff to be. HV would be actually what's happened in the past. So IV, you could think of what they're predicting the future to be like. HV, what actually has happened in the past for how much the stock has moved around. And we're showing currently the stock has moved around at the 15th percentile. But options are pricing in the future the 98th percentile. So what does that tell us? It tells us something big is going to happen in the stock soon. It's going to make a move. At least according to the options. Somebody thinks it's going to make a move because they're buying. There's got to be buyers of the options out here if it's gotten all the way jacked up to this 98th percentile. Okay, so that kind of sets the stage of what's going on here. It shows implied volatility 122. That's an average volatility, and you can see that that's right at the high end of this range. Now, that 122 number probably applies to the front month. I'm not sure of the exact formula they use for it, but it's obviously front month weighted because that is very close to the volatility of the first options to expire in 7 days. Now, if we go to the right over here, we can see option activity, and as I said before, not a whole lot going on. Only 740 contracts have traded today. So this is an illiquid stock. Only 61,000 shares have traded. These kind of numbers, like 61,000 shares trading or only 740 options in a day, these numbers would disqualify this stock for most traders and probably should disqualify it for you. But as far as I'm concerned, I think there's an opportunity here for me, and but I'm going into it with open eyes, knowing that I could be stuck. A, it could be very hard to put this position on. B, it could be very hard to take it off. And so my money is going to be stuck in there for a bit probably. So what am I going to do? What's the trade? Well, the trade is to capture that differential. So to buy the 73 vol and sell the 105 vol. Now, a lot of people would stay away from this because this is going to be a net long Vega trade. The further out options, which are the 73 vol options, are going to have, each option is going to have a higher volatility to it, is going to be more affected by volatility than the options I'm selling. So when we look at the Greeks for this trade, it's going to show us being long Vega. Thus, the scenario that's probably going to play out with this is something is going to happen to this stock. It's going to either gap up or it's going to gap down based on some news that's going to come out in the next week. That's why people are willing to pay all this money for these options. And if you were to dig into time and sales in this issue, you would see people paying what seem like ridiculous prices for either calls or puts. Here we have this guy's buying, let me widen this out so we can see. So this guy's paying 85 cents for April 40 puts. So these puts expire in 7 days. That's down $14, and he's willing to pay $85 a piece for those puts, or 85 cents, but in real terms, $85. This other person there's a big trade went up on these June 40 puts. It looks like there's a buyer of June 40 puts. It's hard to tell because it's mid-market, but it's much closer to the offer side than the bid. So it looks like maybe someone's buying June 40 puts. So right here you see a bunch of trades suggesting that people think this is going to go lower. However, if you were to follow this day to day, there's been a bunch of people buying out of the money calls or buying calls, paying the offer, suggesting that this is going to go higher. So there's a divergence of opinion on this one, but it appears something big is going to happen very soon because of all the willingness of people. People don't just go out and pay ridiculously high prices for options without having a good idea that it's going to pay off for them. And so that's the stock behind me is that's the 5-day, but let's just look at a year chart of this stock, and you can see it in a range kind of. I'll get out of the way here. You can see it kind of in a range. And if I back it out to even 3 years, it's been trading between 40 and 70 in the last 3 years. It's kind of like right in the middle right now. So just to get back to the trade once again. So my idea is to buy the that one month that's a 75 vol and sell the other month that's 105 to 110 vol, and thus it would be buying the SEP June 50 put spread. So this trade is going to I'm going to collect money every day. There's two components to it. One is your long Vega. So after this event happens, volatility is going to come in. So I will lose money on volatility coming in. However, the price of the option I'm selling is probably going to go down way more than the price of the option I'm buying. And ultimately, the decision to make this trade comes down to me to the actual exact price of the trade. And what I was paying for this spread is $1. And so if we look at the option prices on the screen here for a second, we can see the SEP options. So the SEP puts, the market right now is $7 bid at $10. So very wide market, of course. The June 50 puts, the market is $6 bid at $8. So the trade would be something like paying $9 for this 50 put in SEP and selling the 50 put in June for $8. So paying $1 for this spread. And what's going to happen is the June, okay, so June has 71 days till expiration. SEP has 162 days. So at some point, there's going to be an event, and all this stuff, all these prices are going to go way down. My idea is that dollar for the spread is relatively cheap, and it is extremely possible that this June is going to go way, way, way down, a lot lower than the SEP, and that spread is going to enlarge. And I ended up paying about $1.20, $1.19 average to put the spread on 30 times. And I also, I went to some other strikes around that spread so that if it gaps up or it gaps down, I have a little bit of coverage to the outside. But I believe that no matter what happens, the most I can lose is that dollar I paid for the spread. And I think there's opportunities just based on these prices of like buying something for 10 and selling something for 9, or buying something for 9 and selling something for 8. There's a chance that that these can diverge more than $1 in the 70 days to go until June expiration. For example, July options should be listed, I think, next week. And then you're going to see this SEP, which is pretty far out, kind of just stay the same price, whereas June is rapidly decaying. If I do go to like an Analyze tab and take a look at the chart of the risk for this position, and this stuff isn't always completely accurate, but if I look at a chart for the risk profile, you're going to see, and this is like for June expiration. So, and it shows like the position making a whole lot of money, but I don't really, this doesn't take into account the vol crush that's going to happen. The thing with Thinkorswim is it doesn't really model very well, or at least I don't know how to make it model very well, a situation where this is going to gap and then volatility is going to get crushed. So looking at this chart here, it says, oh, you're going to make $15,000 on a very small trade, but I don't think that that's actually true. If you looked at this chart, you'd be like, oh, I'll do this trade 1,000,000 times. What a winning trade. I do think that I think that that's inaccurate because it doesn't take into account the fact that volatility is going to get crushed. And if you look at the Greeks for this trade, it shows me long 147 Vega. So if volatility were to go from 120 to, is right now it's showing like 127. If it were to go down even just 27 points, that's 27 times $147. So that's a lot of money. But you know, it's hard to figure out which is going to be the bigger component, vol getting crushed or just the decay per day for June. So I just, in my mind, when I think of a trade like this, I think, what is the amount I'm paying for this spread? I'm paying $1. I'm paying $100 each for these spreads, and it has the potential to be worth a lot more than $100 each for the spread. And I kind of leave it at that. I'm not even going to adjust my deltas if this moves one way or the other, because that would be messing with the fact of just paying $1 for a spread and the whole philosophy behind it. So we'll have to wait and see what happens with this one. I'm not sure if I've explained it completely well here, but hopefully you get a little bit of what I'm thinking about on this FGen trade. And thanks for watching. I will update you as to what happens next. It is a kind of a sketchy situation because, like I said, this has no liquidity, no volume. And obviously, if someone comes in and really wants to buy or sell a lot of the stock, it's going to be a mover. But for now, I'm hanging with the trade, and we'll see what happens next. All right. Thanks for watching, folks. Good luck to you. If you are trading UVXY, I would suggest to you to wait for the next spike, but to be ready with some ideas about how to take advantage of that spike. I wouldn't necessarily suggest initiating a short trade right now. It could work, but it just seems like, you know, the VIX is at the low end of its range right now. Well, if you look at the chart behind me, it's like kind of, you can still make a case for it being kind of in the middle for the last couple of years. It could get down to 10 again easily. But it seems always better just to wait for a little spike to put something on. So that's would be my suggestion at the moment. Quick look at VIX Central before we go. And it is a beautiful contango chart right now on VIX Central. If we do go to the ProShares website for a second, we can see that we are getting very close to expiration being next week, 17th, but not that close that that we can't really benefit from this contango structure here as far as this decaying. UVXY contango over 10% right now, and so this thing is decaying like crazy. So take advantage of that in one way or another. Keep it in mind. If you're going to get long this thing, remember that you want to pick a time within a 48-hour window to get long it, and if it doesn't work, get out, because this thing is decaying almost before your eyes at this point. All right, well, thank you for joining me today, and I will see you in the next one.